risk management changed after the flash crash that happened last May?
We've definitely seen a bit of more of an interest from the buy side, especially on the way we look at mitigating those types of circumstances. We've always had some level of risk protection around this. So again, what we've always had is a top level at the fixed layer, a middle layer at the algos, and then before an order goes out to the exchange, another sort of validation. And that's always been there given the audit concerns that we have and just the risk of an automated trading system that we've always had. What's really changed since the flash crash is us going back and re-examining all of those controls that we have for clients and understanding and making sure that they are actually tight, right? That's number one. Number two, as I said earlier, our buy-side clients, all of our clients really have been more interested in it. So they're asking us, how do you look at these things? Do you actually have something? Because many of our clients are concerned about triggering the next one of those themselves, right? And making sure, brokers like ourselves are prepared for those kinds of scenarios. To go into a little bit of detail on some of the checks and balances that we have is at Citi, we're very consistent with the way that the fixed protocol has put this paper out. So the fixed layer, as soon as the order comes in, we check against the large order size, measuring it by share count, by notional value, on a single order level basis, but also on a cumulative basis, so that a particular client that generally doesn't generate a lot of orders doesn't somehow send us thousands of small orders that would breach some sort of limit. At the algo level, we have a richer set of data, right? We know what the stock ADVs are, how much it trades on the open, how much it trades on the close, how much it trades in the middle of the day. So we can adjust and calibrate that order size based on ADV or the duration-based ADV. So the functionality and checks and balances are even richer at that level. We've built some customized stuff around our algos as far as not chasing big blocks on a participator or percentage of volume order. We've also built things around our dark pool access because a lot of our clients have been very concerned about the information leakage and possibly gaming that could go on. So there's a rich set of controls that we put in to prevent, which now we're really doubling for risk control as well, because it's the same sort of concerns where clients say, I don't really want to trade if it's well away from where the order came in, either in my favor or away from me, because I have a certain expectation of where a stock should trade, and if it moves outside of those bands, there's something wrong. And more of our clients have asked us to pause it and then give them a call and have that discussion before determining is this normal, and then continuing onward.
Okay, well, here in the UK last Friday, the London Stock Exchange had an outage. How did you put some of those changes in place at Citi?
I think the EMEA market structure has evolved tremendously. So in October of 2009, I think around that time, we had a similar outage on the primary. And sort of the response just from the industry, including ourselves, is dramatically different than what it was last Friday. If you go back to about a year and a half ago, what you saw was basically all trading stopped, right? What has happened since is, it happened in an inopportune time, but what you saw, because it missed the open auction, but we have a script at Citi ready for these kinds of things, whether it's the primary, whether it's the MTFs or another alternative venue, where we can just turn it off out of our market data, out of our crossing, and out of our algos. We construct the best bid and offer across Europe, and we call it the EBBO, European Best Bid or Offer, and that allows us to have a reference price and continue trading. Now, we went back to our clients and said, the LSE's out, right? We can continue trading for you guys, or not, it's up to you. And half of our clients said, no thanks, we'll be out. But some of our very large customers continue to trade, right? So and what we saw is at the beginning of the outage, right, when people said, well, we don't know what's going on. We need to have a little bit more information really before making some determination. We saw the spreads, the MTFs were trading. The spreads were incredibly wide. But as time went on and people realized this was going to take much longer to resolve and they still had risk on their books, then they started layering in the books and trading did occur. Now, it was definitely muted compared to other days until the auction started in LSE and at 12:15 and then it picked back up again. But it's sort of a resilience in the marketplace that we have. From a risk perspective, I think it's very dangerous. Right, I think people are very concerned with MiFID and sort of fragmentation in the marketplace. What this shows you is that fragmentation is good because you actually have ways to get rid of your risk. You know, the rest of the European markets were trading, the futures were trading. The U.S. obviously opened at 2:30 European time, and so people with risk aren't in the situation anymore where they can't get rid of it. So it's a sea change for the market, and we still have a lot more to do in Europe around this because, again, not every market is as fragmented as the UK market is, but I think these are steps in the right direction. And from a regulatory perspective, from an investor protection perspective, it's very encouraging to see that you're not beholden to one market center, and you can continue investing for your end client.
Thank you very much.